Following Iran's sustained and tough counterattacks, oil prices resumed their rally in the latter half of last week, with the risks of ground combat now on the rise. From a chronological perspective, if no agreement is reached this week, it will lead directly into the expiration of Trump's ultimatum. Of course, Trump may choose to grant further extensions or employ other measures to alleviate market panic. Overall, news developments this week are likely to serve as the decisive factor game-changer for most market assets. Iranian Foreign Ministry spokesperson Esmail Baghaei stated that the proposals submitted by the United States to Iran through mediators are extreme and unreasonable. On the patio th, Iranian Parliament Speaker Mohammad Bagher Ghalibaf remarked that while the U.S. publicly signals a willingness to negotiate, it is secretly planning a ground offensive. He added that the so-called 15-point plan to end the conflict is an attempt by Washington to achieve objectives it failed to reach on the battlefield. According to the latest reports from U.S. media on the 29th, President Trump is considering a high-risk and complex military operation aimed at venturing deep into Iranian territory to seize nearly 1,000 pounds of enriched uranium. Sources familiar with the matter indicated that while Trump has not yet made a final decision, he intends to make the handover of nuclear materials a prerequisite for ending the war. Should Iran refuse to compromise at the negotiating table, the U.S. may resort to force to seize the materials. WTI crude oil's weekly chart showed a fall-then-rise pattern last week, leaving a massive lower shadow, which indicates that support at the $80 level is exceptionally strong. A breakout from the primary consolidation range of $76 to $119 would signal the start of a new market phase. However, as with previous weeks, news-driven developments remain highly volatile and difficult to predict. The fundamental logic is clear: ceasefire equals bearish for oil. Ground war equals bullish for oil. If the war of words continues and the status quo is maintained, oil prices will likely remain range-bound. Traders should pay close attention to weekend risks this week, as there is a significant probability of a price gap at the start of next week. Gold plummeted below the 4,100 level at one point last week, but a subsequent bullish counterattack pushed the weekly close into positive territory, leaving a prominent lower shadow. From a weekly perspective, signs of stabilization following 3 weeks of sharp declines suggest a potential short-term rebound, provided that no new lows are made this week. Resistance for a short-term bounce sits at 4,600 to 650, with the primary battleground expected around the 4,875,000 zone. For gold, a long-term top may have already formed, unless a new market consensus emerges specifically that the war will significantly expand, thereby revalidating the buying gold in times of turmoil narrative. The US dollar refused a meaningful decline last week, returning to trade above the 100 mark, bolstered by the momentum in crude oil. Whether it can achieve a further breakout will also depend on guidance from oil prices. From a technical perspective, a sustained move above 100.42 would establish a potential large double-bottom structure, with a theoretical bullish target pointing toward the 104 level. On the downside, the weekly low of 98.49 must be breached for bears to have an opportunity to initiate further downward movement. While long-term pressure from a weak dollar persists, short-term news and headlines remain the dominant drivers. U.S. stocks failed to stage a rebound for the second consecutive week, closing near their weekly lows. The weekly candle body broke below key support at 6,520, signaling a shift in the short to medium-term trend toward further downside. Following the retracement from the 7,000 peak, the weekly chart has now recorded 5 consecutive weeks of losses. Unless the Middle East conflict is resolved quickly, the prolonged uncertainty will exert increasingly visible pressure on the stock market. Regarding short-term rebounds, the broken support at 6,520 has now turned into resistance, while the high at 6,845 stands as the primary resistance level. In the medium term, as long as high oil prices persist, it will be difficult for U.S. stocks to return to a slow bull trajectory. Instead, they are more likely to remain under pressure. Bitcoin spiked and retreated again last week, leaving a notable upper shadow. Although the decline was not significant, bulls have shown signs of exhaustion for 2 consecutive weeks, suggesting that crypto assets are struggling to maintain their previous relative resilience. If other assets remain under heavy pressure in the coming weeks, the crypto market is expected to see a catch-up decline. However, a break below the 60,000 level is required to accelerate the downtrend. On the upside, the contest around 74,000 serves as the primary resistance, while the theoretical double bottom target at the 80,000 mark is expected to remain out of reach.